Welcome to part 3 of our video series here. And in this final segment, Jared and I are going to walk through debt structures, interest-only periods. We're going to talk about the role of prepayment penalties. We'll cover a wide variety of debt structures here. And we're also going to look into sponsor fees and explain how S&S structures its compensation to stay aligned with investors. This section is going to be designed to give you a complete picture of how we think about financing, fees, and long-term alignment with investors. We hope it'll be useful for you. Let's jump in. All right, Jared, part 3. We made it to the last video here in the series. We're going to jump right in to talking about debt and different loan types. So I'm going to run a couple of them by you. I want you to just kind of give me a brief overview of what that term means to you, and then maybe in the context of S&S as well to help the viewer understand. So the first one being agency loans. What exactly are they?
Yeah, agency loans are going to be government-backed loans, most typically Fannie Mae, Freddie Mac. Those are our two options, and those organizations exist for providing most favorable terms to encourage affordable housing across the United States.
All right. What about another thing I've heard is just straight up bank loans, like small banks. How does that work, and how does that relate to S&S, I guess?
Yeah, I guess I'll take a step back and say most of our loans are agency loans.
Okay.
They're the longest fixed rates. They're the best interest rates. They're non-recourse, so they line up with our preference the most. But we do sometimes take on bank loans because the property might not qualify for agency loans. So just also when they're the best, they're also sometimes the most scrutiny, most stringent to get being agency.
Okay, so less risk with the agency, more risk with the bank loans is what you're saying?
If the property is more risk, sometimes you have to go to the banks because the agencies don't want the property.
Yes, okay.
So then for example, if we're buying a value add deal and it's a foreclosure that we're buying and it's got a bunch of vacancy and a bunch of unknowns because it was poorly operated,
right.
We got to go into a different lender because it won't qualify for the agencies. That's going to be bank is where we'll go next. It's local banks, we've kind of outgrown local banks, like 1 to 2 branches, because their legal lending limits are going to be too low. So we're going to focus on like regional banks, that have a higher legal lending limit. But they're more, agencies fit the square peg into the square hole, and they don't bend at all. It's like basically, can you get your asset to fit the loan? The banks are more of a conversation, and they wait, they hear the story behind the deal and all of these things. And with it comes a slightly higher interest rate, maybe a little bit worse terms, but there's advantages to it too. So we typically would see bank loan going into a deal on a value add, and then at the refinance, we would see agency.
Okay, got it. So once the agency feels more comfortable with where you've put the project at in that specific community, that's when you're able to get that kind of a loan.
Yeah, think about it in the analogy of the square peg into the square hole. It's like when you buy these deals, we buy them with problems, and those problems are bumps on that square peg.
Yeah.
And it takes us a year or two to shave off those bumps and get them to where they would conform to the agency loan. And we're not doing that because we're not doing that primarily because it's like that's what the agency wants, is because what they want is what we want, which is a strong cash flowing predictable asset with good financials, right? And so when we take a square peg with a bunch of warts on it and we shave off all those warts and turn it into a good asset, then they're like, oh, we would love that loan. And because it's more favorable in structure and rate, we also love to borrow that money.
How much does the track record of the general partner come into play here with getting these kind of loans, whether it's an agency or a bank loan?
A lot.
A lot?
Yeah, a lot. Just like a limited partner is going to care about the track record to invest $100,000 into a deal.
Yeah.
The bank cares a lot about investing multi-millions of dollars into the debt because ultimately they don't want the property, right? They use the property as collateral, but they want us to run the property. So track record matters a lot. Financial stability, reputation, all of those things matter. And like if as a general partner, if you mess up with the agencies and you default or screw them over on something, like you're not getting any more of those loans. So reputation matters a lot, and the same for banks, right? Like if you do something and hurt a bank by not paying them or struggling to pay, or we talked about debt service coverage ratio. If your portfolio is running too thin, they're going to just shy away from you completely.
Oh, okay. Well, let's never get to that point.
Yeah, and I mean on the banks, a lot of times you have some form of personal guarantee as well.
Yeah.
And so they're going to look at, myself, Andy Coleman, and they're going to say like, we want your net worth and liquidity. Sometimes there's covenants in the loans that we have to hold a certain amount of cash personally, and we can never go below that because they want a safety net to know like, hey, if this thing gets rocky over here,
Yeah.
you're going to throw your own money at it. So there's different components to all of those. I would say 98% of what we do is agency or bank, but there's a lot of other options to borrow money.
Okay, well, let's just briefly touch on a couple other options, one being bridge or construction loans. Can you talk about that a little bit?
Yeah, that's actually pretty common in multifamily value add, but we've never done it. We don't really have an appetite for it because it always comes with higher rates, usually variable rates that we choose to shy away from because of the lack of predictability around them. So it's not uncommon in the industry, but it's never happened with S&S. And then you got hard money loans, you got life insurance, which we have borrowed money from life insurance once, and it's not that different than a bank, but less common.
Okay. What are those life insurance loans? Just from my understanding.
I mean, a life insurance company collects premiums from their clients, and then ultimately they put that money to work when they have all this, have all of it. And one thing they do with it is they lend it out, and so they would lend it out. And one of our properties, North Point Townhomes, we went with a life insurance company, and the rates were pretty comparable to what we could get from a bank. The leverage is a little bit lower usually. They don't like as much risk, but there's certain gives and takes on the terms.
Yeah. Well, I'd like to jump a little bit to talking about the rates that you're getting with these different loan types. One thing that I've heard you mention earlier on in our series here is fixed rate loans and then variable rate loans. What do those two terms mean, and what does that also mean to S&S?
Fixed rate and variable rate are both referring to the interest rate on the debt.
Okay.
So if we borrow money from the bank, $10 million borrowed, we agree to a 5% interest rate. That's going to tell us our interest payment, how much we have to pay that bank. But there's different ways at which we pay that back. Like we might pay it back and they say that interest rate, 5% interest rate that you agreed to, we'll hold that steady the whole time. That's going to be fixed rate. Variable rate is like, well, at the time you took the loan, the interest rate was 5%, but we're going to let it bounce around based on an index of whatever the market does for the life of the loan.
Yeah.
And then you got ARMs, which is somewhere in between, which is kind of like you'll fix for a certain period of time and then you'll start adjusting. What it means to S&S is that, well, let me go back to the most fundamental things. Like we're focused on consistent, predictable cash flow. If you want consistent, predictable cash flow, you better have consistent, predictable debt service.
Yeah.
And with that comes fixed rate debt. So I said we've never used bridge, we never used construction. It's because we want that consistency and the consistency and predictability. And I know this video is for like the investor that's trying to educate themselves, and it goes back to that question over and over of like, well, what are you trying to produce, right? I'm not saying bridge loans are bad or variable rate loans are bad. It's like, if you're looking for consistent, predictable cash flow, and then you invest in a development deal with variable rate loans and a bridge and construction loans all layered in, it's like you're not going to get consistent or predictable cash flow. So I just encourage investors to think about, what am I trying to produce with this investment, and does the business model and underlying debt align with what is likely to be produced from that?
It's very helpful. I do wonder, there's this term that I hear a lot, interest only. What does that mean when you're taking on, so say we take on a hypothetical fixed rate loan, which sounds like is most common for S&S deal. What is interest only, and how does that impact we'll start with cash flow, and then we'll work our way down from there.
It's very common in commercial loans to have some interest only period. Probably even more common in value add, because you're going to convince the lender, hey, during these early years, there's less cash flow, and so I need a little bit less debt service. So back to that debt service coverage ratio, the debt service is the combination of both interest and principal.
Okay.
But interest only is when you're not making principal payments. You're only making interest payments. So amortization, or the decrease in principal of a loan that you borrow on, is what most people are familiar with their single-family primary residence, right?
Yeah,
You
yeah.
pay on it, and some portion is interest, some portion is principal, and slowly but surely you kind of chip away at that principal amount till your mortgage is paid off.
So the interest is not chipping away on the amount that you owe, but the principal is what you're saying.
Correct. Yeah.
Okay.
And so interest only means all you're paying, your entire debt service for a certain period of time. Usually it's like 1 to 3 years of the total loan.
Yeah.
Usually at the front end, is going, 100% of your debt service is going only to interest. So if you borrow $10 million and you have 3 years of interest only payments, at month 36, you still owe the bank $10 million, and everything you've paid them for that whole 3 years
Yeah.
is exclusively going to interest, meaning just the yield that you pay to the bank on the privilege to borrow their money.
And so that would impact cash flow, like you said, early on, because we need to have a little bit more flexibility as we're doing that value add.
It impacts cash flow to the real estate owners in a positive way, because if you think about it, if your debt service, which eats away at the cash flow,
Yeah.
is lighter, meaning you're not having to pay that principal
Less
portion.
of a payment, yeah.
There's more left over for you as the owner to distribute. And going back again to what are you trying to accomplish? If you're trying to accomplish consistent, predictable cash flow, then it's like, well, great. Then we are getting more cash flow, and it's very predictable because we know exactly what those interest payments will be during that period of time. Now, if your strategy was, I don't care about cash flow, I don't want distributions, and all I want is to boost my net worth, then a great way to boost your net worth is through paying down principal and owning a higher portion, because your loan to value would be driven down every principal portion that you make.
Yeah.
So it's like, well, what are you trying to accomplish, right? No right or wrong on how you structure debt, but
There's just different deals. And
yeah, like I'll take as much interest only as they'll give us usually, because it's like that's only going to strengthen your cash flow in over the life of the investment.
And how does that interest only period impact your planning for that refinance event that we've talked about a couple times now in this series?
Not a ton.
Not a ton.
Yeah, I think that somewhat it's like a drug. Interest only is like a drug, because it's like, oh, that makes your cash flow stronger. And so if your interest only period is going to end at 3 years,
Yeah.
a lot of times you can put a new loan on at year 3 and do a refinance and reset the interest only clock and go back to it. So it's like, I guess it does a little bit, but I would have no problem if it was a loan that had 1 year of interest only and we had to start paying principal. It's all just a math equation to make sure that your bottom line and your return on capital is strong enough, whether you're paying interest or principal, because sometimes the bank loans don't have any interest only period, and it's like, well, it doesn't
Yeah.
have it. Does it still produce what we're chasing?
So, I mean, say you have a deal where you have 3 years of interest only off the bat. What if the market shifts at that point when you're coming off of the interest only? How do you think about that as you're starting to pay not only interest only, but say you go into a different market, maybe a less favorable one, and you're paying principal now too? Is that something that you're probably keeping in mind too as you evaluate deals?
For the loans that we're taking, we already know what those numbers are going to be.
Okay.
So when we close the deal, when we take that loan,
So that's the fixed rate debt is what you're saying?
yeah,
Yeah.
it's in the principal portion. Once the interest only period burns off, the principal portion is predefined by the amortization schedule. So
Okay.
25 years, 30 years, how are you breaking down that hypothetical $10 million that we borrowed?
Yeah.
And how quickly are you chipping away at it? All of that is predefined.
Yeah.
So it's not like we're getting caught off guard at the end of the interest only period and saying, oh, wow, we didn't anticipate this. It's all laid out for the whole life of the loan, exactly what those payments would be.
And if you are going to hit that refinance event, there's probably going to be some kind of a penalty, I would assume, or you would probably have to make up that payment. Can you walk me through, I think the term I've heard is prepayment penalties, or there's a couple other different ways to describe it. Can you just unpack that a little bit?
There's so many ways to structure it, but
Yeah.
we talked about agency being the agency loans, Fannie Mae, Freddie Mac being the primary, and there's different prepayment penalties within agency, but most loans will have a prepayment penalty, which all it means is if you took a 10-year loan because you wanted that consistent, predictable fixed rate,
Yeah.
and you pay it off in year 3, the bank doesn't want that to happen and will usually have some kind of penalty associated with it. And the lesson I hope that I can convey is I think too many real estate syndicators don't properly convey that or weigh that in their projections. And so they might build in a refinance in year 3,
Yeah.
but not factor in the prepayment penalty, which can be extremely large, right? If you're not structuring it right, if you get yield maintenance as your prepayment structure,
Yeah.
which we won't go into how that's calculated, but taking a 10-year loan with yield maintenance and refinancing year 3 is pretty much impossible unless you see rates really, really decline over that life.
Yeah.
So I think it's just the lesson I hope to convey is make sure your debt structure, including fixed, variable, whatever you're taking, including interest only, including prepayment structure, all lines up with the underlying business model. Because to say you're going to take a 10-year fixed rate loan and do a full agency 10-year fixed rate loan and do a full refinance in year 3 is unlikely, right? But if someone says, I'm going to do a supplemental loan in year 3 with an agency loan,
Yeah.
that aligns with the business model. And so in real estate, debt is extremely important. Structuring of debt is extremely important. And you better line the two up, or else when things don't go to plan, if they're disaligned, that's when people get in trouble.
And that's helpful to know as an investor looking at these offerings, and it's nice to know that you're looking that far out too. So great. I feel good about the debt structure. I do want to jump over to compensation structure, specifically relating to the GPs. And this is something that we've touched on a little bit earlier on in our video series, but I wanted to dig into it more. I know we talked about the 70-30 split, preferred return. I want to focus more on fees. I know this is something that as an investor, I would want to understand how the general partner is being compensated. And they're on every offering that you look at, there's a different fee structure. I mean, there's a common pattern, I guess, for a lot of them, but let's just go one by one and walk through what is more normal for the market and then what is normal for an S&S deal, starting with the acquisition fee. And what exactly is that too?
Acquisition fee is there to help sponsors be incentivized to go out and search the market for opportunities, put that opportunity together, and then present it to investors. Industry standard is going to be 1 to 3%, meaning 1 to 3% of the purchase price usually.
Okay, so $10 million deal.
Yeah, it's
Okay.
$100,000 to $300,000 is what the general partner will make when the deal closes. So think of it the same as like a real estate agent, right? It's kind of like what did the house sell for? They're going to get 3%, I think, is the number in common single-family homes.
Okay.
So think of it like that. S&S charges 1%. We're more focused on the long-term equity building potential and would rather have more of the split than fee to death, which I think is more of an alignment of interest.
Yeah.
If you see, as a limited partner, if you see structures that are too much weighted to the way the general partner makes money is through fees, in my opinion, that disaligns the interest between LPs and GPs, because it's like, you get the acquisition fee the day we close, but for us, there's 10 more years of work that comes, and it's like, as an LP, I want you working for those 10 years, not just like checked out after day one because you got your acquisition fee.
And that ties back into that part one discussion we had on alignment of interest, and I think the rest of this conversation will too. One thing I hear a lot is asset management fees. What are those?
Yeah, and I got to talk a little bit about splits to get to this. So it's pref and splits, but
okay. Well, then start with the split and pref, and then we'll work our way from there.
Okay. So we talked in part 2, I think, is we talked about our structure, and there's no right way to split this, but like our structure is a 70-30 split with an 8% preferred return. So you have to imagine that the first 8% of yield goes exclusively to the limited partners. Anything over that 8% gets split 70-30, which means like even if you're producing a 10% cash on cash return, which is a strong return in today's market, the general partner, I think if I'm calculating this right in my head, is going to have 60 basis point return, right? 0.6% return and that's not enough over a really long period of time to keep the lights on. So when we think of asset management fee, a lot of times it's help covering S&S Capital Group's overhead, right? The softwares that we buy to have investor portals, payroll for the staff to go out and look for those deals and do investor reporting and all of the things that, the back end overhead. It helps keep the lights on until we get to those real big components where we make the most money, which is refinances and sales. So asset management fee for us is 1%. I've seen anywhere from 1% to 5%, but very rarely. I guess I've seen anywhere from 0 to 5%.
Yeah.
But ours is 1%, and it helps us. That's going to be 1% of effective gross income. So effective gross income is kind of all the income that comes in, and we're going to take 1% of that off the top to kind of keep the company running until we can go get our bigger split, which is the 30%.
Okay. That's extremely helpful. I do want to ask about disposition fees. I've seen this on a couple offerings. Is that something that SNS employs?
We don't.
Uh-huh.
I don't think they're unjustified because it's a tremendous amount of work to prepare a property for sale, take it through the sale process, and successfully execute on that sale. So
Yeah.
I'm not saying that those who charge them are doing anything they shouldn't be doing. But when we talked about initially, when we created our structure, we talked about alignment of interest. And if there was any opportunity for the question to come up, and investors should be thinking about these questions as they look at any sponsor, is like, why is the general partner doing that? Whether it's deciding to refinance, deciding to sell, deciding to invest in construction. If there is a fee associated with those actions, it could potentially create the question of like, for disposition fee, is the general partner choosing to sell because it's the best time to get a 1% to 3% disposition fee, or is it the best time to sell because it's the best time to sell? And so if there was any of that like gray area, we just said like, look, we'll make our money on the equity split, and we're going to get rid of the disposition fee.
Yeah.
So we do not have a disposition fee. Potentially it's on your list, I don't know. We do not have construction management fees
That was next.
because
Yeah.
it's that same idea of alignment of interest, and like, are you investing into the property and doing all this construction because you get a 25% general contracting fee and markup on materials? Or are you investing in it because it's the most wise investment for the outcome of the investment and ultimately the results to even the limited partners? And so alignment of interest is extremely important. And I would say even equally as important, you talk about skin in the game in part one, skin in the game, alignment of interest. Like, you got to have both of those things, because
Yeah.
if you take a huge acquisition fee on the deal and you just put that acquisition fee into the project, is that really skin in the game? I'm not really sure it is. So fee structure matters a lot for alignment of interest, and just investors need to think about that of like, do you want to be thinking, why are they doing this? Or does the structure itself eliminate that question to where you don't have to worry, and you say, I hired them as the general partner because they're the expert and their interest is directly aligned with my interest, and so I don't have to think, oh, they're doing this just because it's better for them than it is for me. So we took away all that noise and just kind of said, like, let's boil it down to the absolute basics on fees, and we'll focus on making our money on the equity split.
Yeah. Thank you, Jared. And I think kind of just wrapping up here with us, it's that accreditation alone doesn't make you, it might not make you a good investor, and I think that education is important. So I think the point of these 3 videos really was to lean into that and try to use SNS as an example to help understand a lot of these key terms and variables, which there is a lot of them that come into play here with alternative investing. So thank you for your time.
Yeah, I want to piggyback on that.
Yeah.
The premium, you talked about alternative investing relative to the more typical of stocks, bonds, mutual funds, 401ks, things like that.
Yeah.
The premium of returns that you get are earned through this effort. Like, you don't have to make that effort if you're just dumping blindly into your 401k and it's going into some mutual fund and you just want 6% returns.
Yeah.
Like, if you know that's what you want, that's fine. But if you want double-digit returns, you need to exchange something for that, and it's not just dollars, because if it's just dollars, then you should go to the mutual fund. It's also some form of education, some form of sophistication, some form of understanding to vet these alternative investments. And so that's why I appreciate you producing these videos, is because you're producing the content that helps investors earn that knowledge that then ultimately earns them that premium. So hopefully they'll lean into this and understand that that's kind of a responsibility of being an accredited investor, in my opinion, is not just how much money you make, but like, do you understand what you're doing with that money? So,
Well, thank you, Jared. Thank you for your time, too.
yeah, thank you, Steve.
Well, that concludes our 3-part video series on multifamily syndications. We hope that this gave you a clearer picture of how SNS approaches deals, evaluates risk, and structures investments, and just overall was useful for your education. Remember that being accredited is just a starting point, and understanding how to analyze opportunities is truly what sets you apart. So at SNS, our commitment is to keep educating, keep sharing openly, and to build long-term trust with our investors. Thank you again for joining us.